it's been a challenging 12 months, actually. If you look backwards, we had the highs of 2022, and then in 2023, with the global macroeconomic challenges out there, it put a lot of pressure on our business. But what we've seen progressively over the last few quarters is modest improvement, and this quarter extended that run. All in all, a satisfactory quarter. There are still challenges out there, but we are seeing progressive improvement.
Let's talk about those challenges. I mean, where are you seeing improvement when you look at the different segments?
First and foremost, our most important segment is dissolving pulp, which goes into textiles. And all in all, we've seen demand recover substantially over the course of the last 12 months. And we had a pretty good quarter. Selling prices were up, demand remained strong, and all in all, the margins in that segment were very, very good. On the paper side of our business, we're in two broad segments, the graphic paper and packaging. And the recovery there has been a little bit slower. Mainly in Europe. The European economy has been weaker than other economies, and it's taking us a little bit longer. And because of that, we actually closed 2 mills in Europe in the quarter. That enabled us to take fixed costs out of the business and boost margins. The underlying demand itself continues to improve, but it's a little bit slower than we had earlier anticipated.
Building on that, reading your actual statement from a sense point of view, you talk about, in terms of the gradual recovery that you're seeing when it comes to graphic papers, it is there, but there seems to be some kind of structural decline. How are you offsetting that structural decline?
Yeah, that's fair to say. Look, this is a segment that has been in decline for some time, and obviously with the weak economy in the last 12 months, that has accelerated a little bit. And what we've been doing is twofold. I mean, firstly, we've been looking for opportunities to convert some of our capacity out of that segment into the faster growing, higher margin segments, the packaging. And we've got a big project underway at the moment in the US to convert one of our big machines and expand the capacity, but on the packaging side. In Europe, it's, as I say, a little bit more tougher, and we have been forced to close 2 mills. The benefits of that are twofold. Firstly, obviously, we take out costs out of the business, but at the same time, we shift the sales and the capacity that was coming out of those mills, we shifted to other mills in Europe, and now that's enabled us to fill those mills, and the operating rates at the remaining mills are now very good, and that will obviously help with margins. So all in all, our strategy is to reduce our exposure to this declining graphic paper market.
With that said, let's talk a little bit about that packaging and specialty paper side of things. I mean, you mentioned that you're seeing a strong recovery in North America. You've touched a bit on Europe, but let's talk about what you're seeing when it comes to South Africa, especially as it relates to demand and what that impact means from a sales volumes perspective.
Yeah, in South Africa, we've got a very good business. We predominantly sell into the fruit export business, predominantly citrus fruits, and the prospects longer term and in the shorter term are very good, and we are anticipating volumes to continue to grow in the years ahead. Over the course of the last 12 months, there was excess inventory in the supply chain, packaging inventory that is, and that caused things to slow down a little bit. However, things are picking up once again, and as I say, the prospects looking forward are very, very good. And when you read about the prospects for fruit exports out of South Africa in the next 10 years, it is very, very favorable. And obviously, for us providing the packaging to that segment, it's very good as well.
We have an environment where we're seeing the global consumer environment a little bit under pressure, and then you add in high interest rates. Let's talk a little bit about cost inflation. Last time you mentioned that it was a risk. Is that still a risk?
Yeah, most of our products go obviously into markets that ultimately depend on the end consumer. And as you indicate, the consumer, the global consumer, has been under tremendous pressure with inflation and high interest rates, and that's still with us. So that's why it's taking time for our markets to progressively recover. I would say that cost pressures are still there. However, we've realized that, and we've been taking significant costs out of our business. And if in the numbers that we've just reported now, we were able to take about 9% fixed costs, which help mitigate against the impact of higher costs. Having said that, some of our raw materials, the prices for those have started rising once again. So we need to continually focus on productivities, efficiencies, and look for opportunities to offset costs further.
Just to add to that, what are you seeing in terms of order activity?
It's getting better. It's actually each quarter is getting better, and that's across all the segments. So whilst it's been slower than we would like, it is getting better. And in the quarter ahead, we expect that trend to continue, and I think it's going to extend into our final quarter of this financial year. So all in all, we are encouraged, and obviously at some stage interest rates are going to come down, and that's going to help with consumer spending, and ultimately we'll be well positioned to benefit from that.